Hello investors and future investors, welcome to the channel. For today's video, I'll be showing you when to use the cash secured put versus the covered call option strategy. Now, I'm pretty sure you've seen lots of videos on these two option strategies, but do you really know when they should be used? That's what we're going to cover in today's video. Now, if you're new to options trading or you're trying to use options trading in order to make some additional income in order to add to your 9 to 5, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to be showing you exactly when to use the cash secured put versus the covered call option strategies. I'm going to show you what you actually need to look for in order for you to make an informed decision which option strategy is best to get done at that point in time. Now, in order for us to go ahead and do that, we're going to start off today with Robinhood Markets, ticker HOOD. Now, right off the bat, we're going to go into the Robinhood Advanced feature right here in order for us to open up the chart. Now, before I go ahead and continue, I always have two requirements for my viewers and also my subscribers. Quite simple requirements, if you ask me. Number one is always going to be always make sure to do your own due diligence before investing. What may work for my portfolio, quite frankly, may not work for yours. The second requirement is going to be always make sure to have an exit strategy before entering any options trade. Now we got that out of the way, let's go ahead and I'm going to show you what information you're looking for in order for you to do an option strategy. So here we are on the Robinhood charts, and now we're going to go to the 1 year mark. Okay, so here we are on the chart, and we're gonna put a line right here. Now this line here shows us a very defined what's known as a support level. That support level is around, let's say, the $50 mark right there. Now if we were to go a bit further down, draw another line there, we're gonna see another support level, which is gonna be around $45 mark. So we have $45, and then we have the first level of support, which is going to be the $50 mark right here. Now, I usually like to use two predominant indicators in order for me to make a decision what option strategy I'm going to be using. So the number one indicator would be this blue line right here, which is the 200-day moving average. Now, if you are trading with Robinhood, you could go ahead and you could add this to your chart. You just go to the left of your screen right here, and then you could alter these right here by going to the little settings icon right here. Good. Now, with the 200-day moving average, what that tells us, it gives us an estimate of where the share price has been trading for the last 6 or so months. So right here, you can see Robinhood has been trading at around the, let's say, $38, $40 mark. It should be trading around that mark right now. However, the current price is at 62.79, which is trading way above the 200-day moving average. So right there, you could use that decision in order to make a very good decision. However, every good trader, every good investor knows that you should always get secondary confirmation or use a secondary indicator just to confirm your thesis. So what we're going to do, we're going to stay on Robinhood because I don't want you guys to move away from Robinhood. I want you guys to use what's available to you in order to get these things done. So we're going to go right below the chart and we're going to use our RSI right here. The RSI is a momentum indicator, and RSI actually stands for Relative Strength Index. So Robinhood has an RSI right now at around the 62 RSI. Now, just as a guidance, when checking out the RSI, the comparison you want to use is between the 70 mark and also the 30 mark. With any stock that's trading closer to the 70 mark tells you that that stock has been going close to what's known as overbought territory, meaning the price is getting very high. Now, as opposed to that, any share price that goes closer to the 30 mark tells you that that stock is going into oversold territory. So where Robinhood is trading right now is very close to overbought territory. So once again, this is telling us that the price of Robinhood is very high right now. So using that information, which option strategy you think we're going to go ahead and implement right now? So let me know in the comments below. And let me go ahead. I'm going to show you right now. Let's go back to Robinhood. So we're going to go down the bottom and hit trade hood options in order to open up the option chain. Now, This here is the option chain. And what the option chain does is that it gives us lots of information in order for us to make a very informed decision. So here's the option strategy I would do with this stock. And based on the indicators I just went over, I'm going to go ahead and do another stock after this one and show you the other option strategy based on different indicators. So now we're going to go to sell. We're going to go to put. Now we're going to choose our strike date. Now the strike date that could be used is going to be either June 13th, which gives you 18 days to expiration, or June 7th, which gives you 32 days to expiration. Now, the strike date is a matter of preference based on your portfolio goals and your portfolio outlook. Now, I like to do either biweeklies or monthly. They're both good. By using biweeklies, you have a lot less time with your capital being tied up on any option trade. By using monthly, you have a lot longer time for your capital to be tied up. However, you do have more time in order for whatever trade you do to withstand the volatility of the market. So just for today's video, we're going to be using the June 13th, which is going to be 2 days out. Okay, so now that we got that out of the way, we're going to go ahead and choose our strike price. And I'm pretty sure by now you have guessed what strike price I'm going to be choosing. And if you guessed the $50 strike price, you're absolutely correct. The reason why I'm going to go with the $50 strike price is because I just showed you it has a very clear level of support right there. Now, with the $50 strike price, you have a chance of profitability of around 88%, which is extremely high. The reason why this has an 88% chance of profitability, that tells you that there's an 88% chance that this trade works out in your favor. Now, in addition to that, you're going to be paid for this option strategy. Let's go ahead and click into it. This option strategy that I would use to trade Robinhood right now, based on the two indicators, based on the support level, and based on the current share price of 62.79, I would be using a cash secured put on Robinhood. What the cash secured put does is that it allows you to acquire a stock at a lot lesser price. While you're doing that, you're waiting for the share price to go down in value. You're now allowed to get consistent income, and that consistent income you're going to use in order to help grow your portfolio. So the $50 strike price here, a very high chance of profitability, and you're going to be paid about $50 every 2 weeks once this trade continues to work. In order for you to do this option strategy, you're going to need to leave a collateral. The collateral you're going to need to leave is going to be the $50 strike price multiplied by 100. And that's simply because each option contract contains 100 shares. So with this option strategy, you're going to need to have around $5,000 in your portfolio in order to execute this strategy. Now, options is not black and white. You need to play with options. You need to get down and dirty with options in order for you to understand it, and in order for you to choose whatever outcome you want. Now, let's say you don't have a portfolio of $5,000. All you do, you simply go ahead and you go down just a tad and see what works for your portfolio. So we did see the first level was $50. So let's check out the $45 right now. So at the $45 strike price right now, you have a even higher chance of profitability of 92%. Now, because your chance of profitability has gone way up, the amount of income you're receiving is going to go down. Now, instead of $50, you're going to be receiving $18. You have to decide for your portfolio if this is going to work for you. Do you feel comfortable risking $4,500 in order to make $18 every 2 weeks? And the $45 came about from $45 strike price multiplied by 100 shares. But remember, when making these decisions, you could only make those decisions based on your portfolio value. So that's very, very important. Now, how does the cash secured put work? The whole point of doing the cash secured put is to do it on a stock that you actually want to own in your portfolio. You've already done your thesis. You know it's a good stock. However, you think the share price is a bit high, and that's confirmed by the indicators we just saw. So you still want to own the stock, but you're prepared to get at a much lower price. So you implement the cash secured put, and come expiration date, if this share price were to go now to $45, now you're going to own 100 shares of a stock that previously used to trade at $62. You're going to own that at $45 per share. And that is one of the powerful option strategy, the cash secured put. Now, while you're waiting for the share price to go down, sometimes the share price may never go down. However, that is not going to stop you from making consistent income by doing this option strategy over and over again. So there you go. That is when you should use the cash secured put. When it's a good stock, number one, it's a stock you don't mind owning in your portfolio. And when you decide based on your thesis that the share price is a bit high for right now, you use the cash secured put in order for you to make consistent income and try to get that stock at a much lesser price. Now, when are you going to use the other option strategy? So for that, let's go ahead and we're going to use a different stock, and that's going to be TTD or the trade desk. Now we're going to do the exact same thing, and we're going to go build up a slide thesis by doing some basic due diligence. So let's go ahead into the Robinhood Advanced feature right now. Now, for those of you that are still here, if you guys haven't already, go ahead and like the video, and remember, subscribe to the channel. So now we have the chart open on trade desk. We're going to go once again to the 1 year mark in order to see how it's performing. Now, trade desk used to be right here at 120, and you see this big drop here. This is what's known as a gap down. Now, at the gap down, if you were to draw a line right here, you'll see another level of support of, let's say, around the $60 mark. If you go all the way to the end, you can see the price right here. So now that it has a huge gap down and it's trading at $60 mark, you can, if you're an ultra conservative investor, employ the cash secured put. So the reason why you want to do that is because although it has a super gap down, no one knows if the share price is going to continue to tank or it's going to go up tomorrow. We don't know that. That's why we do option strategy based on a few information we have at our disposal. So if you're ultra conservative investor, you could use this to do a cash secured put. However, the option strategy I'm going to use on this one is going to be the covered call option strategy. And here's why. The share price right now is around the $73 mark. Now, if you were to put a line right here, you could see that there's a clear resistance at the $80 mark. Now, that clear resistance tells you that the stock right now is having difficulty going above it. Now, usually when stocks break the resistance, they continue to just ride high. So, current share price around $73. However, our 200-day moving average tells us that this stock should be trading around the, let's see here, around the $96 to $97 share price. So currently, the share price should be around $97, $98 right there, but it's trading, however, for around $73. Let's go ahead and check out our RSI. The RSI on this is around 48, which is smack in the center. So that's definitely on the sweet spot where you want your RSI to be. So what option strategy are we going to be using with this? So $80 support right here. It should be trading around the $98. So let's go ahead and get into the options trade for that right now. So let's go ahead once again. We're going to open trade TTD options. And now we're going to go to sell. We're going to go to call. Now, stay with me. Let's go ahead and stick to the precedents. And we're going to still be using the 2-week, which is going to be June 13th, which gives us 18 days to expiration. Now we're going to go ahead and we're going to choose our strike price above the current share price. And I'm pretty sure you guys know what strike price that I'm targeting. And if you guess the $80 strike price, then you definitely hit the nail right on the head. Now, as I just showed you, the $80 strike price presents a resistance. You don't need to choose the $80 strike price, but it's a very fair bet. Now, at the $80 strike price, you have a chance of profitability. The chance of profitability of this one is going to be 81%. Now, I love nothing better than doing income generating option strategies. So with this option strategy, once again, you're going to be paid. The amount you're going to be paid is $1.15, or in the real world, that's going to be $115 because each option contract does contain 100 shares. Let's go ahead and click into that one. Now, this option strategy is the covered call option strategy. So with the covered call option strategy, in order for you to do it, you must own 100 shares of the stock. Now, I just showed you that Trade Desk had a huge gap down. So if you were to do the covered call option strategy on Trade Desk right now, you'd have to purchase 100 shares at the $73.75 mark, which is going to cost you roughly around $7,400. Now, this is barely an example. When you're doing the covered call, always make sure you look for a stock that's trading with a share price around your portfolio size. Remember that, don't trade higher than your portfolio, but just use this as the strategy that you'd want to use based on the 2 indicators we just showcased. Now, how does the covered call option strategy go ahead and work out? So come expiration date of June 13th, if this share price right here goes up but does not hit your $80 price right here, then you're going to keep your 100 shares that you paid for at 73.75. You're going to keep those 100 shares in your portfolio because you had to use them as collateral. Now that you keep them in your portfolio, what you could do is that the next trading period, you're going to go ahead and do this exact same strategy in order for you to get some additional income. And that is how you be consistent with this option strategy and continue to make consistent income that's going to be used to grow your portfolio. Now, in the event that this trade goes against you, and now the share price at expiration is higher than the $80 price, now you're going to lose your 100 shares. This is the best part of this option strategy. You're not afraid to lose 100 shares of the stock. Remember, do not get married to stocks. These are inanimate things. They don't have no emotions whatsoever. You're here to make money. So you're going to lose your 100 shares. However, you're going to lose your 100 shares at $80 per share, not the price you bought it at. Remember, we did buy it at $73.75. Let's just round it up at $74 per share. So it cost you $7,400 to acquire 100 shares of Trade Desk. Now you lost your 100 shares, but now you lost it at $80 per share or $8,000. The difference between the price you got assigned of $80 and the share price of $74, that's going to be a $6 spread. That $6 spread, you multiply that by $100, and that's going to give you $600. That $600 is what's known as your capital appreciation, or how we like to call on this channel, your investment gains. So that is when you use the covered call option strategy. You want to use the covered call option strategy when a stock has a share price that's trading down from where it actually should be trading. Make sure to do your own due diligence and come up with your own thesis. Now, you want to use the cash secured put when the share price is overpriced, again, based on your own due diligence. So there you have it. The cash secured put can be used in order for you to make consistent income. The covered call option strategy can be used in order for you to make income. The difference is you need to know when to implement either of these option strategies in order for you to get most bang for your buck. Now, if you guys have any questions about the covered call option strategy versus the cash secured put, when to put it on, or you're looking for any additional help with options, well, I do offer one-on-one coaching, and that link is going to be in the description below. Now, for those of you that made it to the end of the video, you guys are the real MVP. Go ahead, like the video, subscribe to the channel, but most importantly, go ahead and share the video with someone out there you think can benefit from its content. Let's help as many as we can get away from that regular 9 to 5. Now, until the next video, keep pushing your investments.